Welcome traders, my name is John, founder at Hooked Up Trading. Thanks for following. Today we're going to be discussing covered calls. During this video we're going to go over the strategy, the thesis you should have, what's required to get into these types of trades, how selling covered calls limits your risk but also limits your potential reward from the trade, the math behind an example trade that we made from the group. We're going to go through what would have happened had share price gone down rather than going up, how to close the trade, and also one of our top ideas for next week's trading. Covered calls constitute a conservatively bullish trade. In order to sell a covered call, a trader must first purchase 100 shares of common stock and then sell a contract against the shares. The shares act as necessary collateral for the contract. The seller of the contract immediately collects the contract premium, and this can be seen as a hedge against potential losses or an immediate return on investment. Best case scenario would be share price rising slowly and contract expires worthless. Worst case scenario, share price falls more than what was gained in the contract premium. Because you're buying shares to enter these trades, being bullish on the underlying stock in the long term is very important. Picking a company to do this with can be done with a few simple things. Checking fundamentals like debt to equity ratio, free cash flow, earnings reported versus earnings estimates, balance sheets, and other things can be used to create your thesis. Now that you have an idea on the strategy and the thesis you should have when entering this trade, we're going to talk about what's required. Selling a covered call requires the contract seller to own 100 shares of the underlying stock. Because this strategy requires the purchase of 100 shares, a larger amount of capital is required than other option strategies. The seller must continue to hold 100 shares of the underlying stock until the option trade is closed. The trade can be closed by purchasing the contract back or allowing the option to expire. Your account also must be approved for level 2 options trading in order to collect a credit for selling a contract. When entering into a covered call trade, it's important to understand how this limits your risk but also caps your reward. By selling the contract against your shares, you receive an immediate return on your investment via the contract premium. This allows the stock to be able to trade down and still be positive on the overall trade. However, if the share price is trading down, the contract sold will expire worthless. Now that the contract has expired, a new contract can be sold for the next week, month, quarter, depending on your strategy. Selling a contract also limits your maximum profits from the shares. If you sell a contract with a $30 strike, you still have to sell the shares for $30 even though the new share price is $40 at expiration. And then I've got just kind of a little chart here to show you how it's kind of as the risk goes up and the reward goes up, but the covered call kind of keeps you capped, so you're not really taking on the extra risk, but you're not subject to the extra reward either. Now we're just going to look at an example of a trade that we did from the group. We traded FUBO and purchased the shares at $25.06, and then we sold the $30 call with a 12/18 expiration at $182. When we sold this contract, it was about 20% out of the money. So you needed $25.06 per share times the 100 shares. The initial investment into this trade was $2,506. And then the contract premium that we collected was $182 times the contract multiplier was $182, which we got back immediately. This contract eventually expired in the money, and we sold our 100 shares for $30 each for a total of $3,000. And from this trade we net $676 when you add the contract premium and the difference in share price for what we bought and sold. However, I was talking about how these types of trades limit your risk and also limit your reward. On this trade, it limited our reward. When the contract expired, share price was just over $40. Had we only bought the shares and sold the shares, the profit from the 100 shares would have been $1,510 rather than $676. As you can see in the math, $676 was profited from an initial investment of $2,506 in a relatively short period of time. However, $834 was left on the table with the share price where it is currently. With a bullish thesis, this trade was very safe, but profits were limited by the strategy. At expiration, the contract sold for $182 was worth $925. Simply trading the contract would have been more profitable, but also would have carried more risk and would have required holding through some pain initially. Selling the covered call was a much safer and more comfortable position. Although some profit was left on the table, more than 25% in just a couple of weeks is a substantial return. Now let's talk about what would have happened if the share price had fallen. If the share price fell, the trader holding the shares begins to lose on share price. However, the shareholder collected a premium for the contract sold. With the share price falling, the contract will expire out of the money and be worthless. If share price falls more than the premium collected, the trader would then be negative on the trade so far. Once the original contract has expired, another can be sold. This is why it's important to be bullish in the long term on the underlying stock. The trader still owns the shares and more contracts can be continuously sold over time after the last contract is closed or expired. When it comes to closing these positions, the trader has two choices. The contract seller can simply let the contract expire or buy to close, meaning to purchase the contract sold in order to close the position. This can be done for a few reasons. The shareholder may have decided to keep ownership of the shares and purchases the contract to eliminate risk of losing the shares. The contract premium may have fallen due to theta and can be repurchased, creating profit equal to the margin between purchase and selling price of the contract. Or share price may have fallen, creating a lower contract premium, making it possible to buy to close and resell at a later time. Once the initial contract has been closed, the trader can then sell the shares or continue holding them and choose. If they choose to sell another contract, that's definitely a choice too. Now we're going to talk about next week's top trade idea. The company is Sunrun, ticker is RUN. Our thesis is very bullish on this company. The strategy is to be long calls, and our entry trigger is going to be support confirmation at 62.4 or a breakout above 64 that coincides with a large amount of volume coming in. The contract I will be looking at specifically is going to be the $70 call with a January 15th expiration. The profit taking levels are going to be 64, 65.1, 66, and 67.1. Our stop's going to be a breakdown below the entry trigger. And remember, these are just trade ideas and are not financial advice. If you decide to also make these trades, the risk is yours. Alright, so this is some charting that we've got for Sunrun, ticker RUN. Monday morning, we're going to be looking for a little break below the trend line here and support confirmation around 62.4. But then we're also going to want to see a break back above the trend line, the support for the trend channel. And then if it opens up Monday morning, we're going to be looking for a strong breakout through the 64 level. And then we'll enter on that. And then these flat lines are all potential profit taking levels. And then we've got the trend support and the trend resistance creating the channel. Anytime the share price reaches towards the top of the channel, the price is going to be looking kind of extended and a little bit overvalued. And that's going to be a good opportunity to take profits. And while it's not going to have a $5 jump every day, we are very bullish on this and we should see a reasonable gain definitely before January. But this one's going to be really volatile also, so it could be a chance to buy and sell multiple times before January rather than just buying one time and holding it through. We do expect to see the $70 break, but because of the value of the contracts, holding it all the way through could be cutting it kind of close on making it to the break even. So we probably won't be doing that ourselves, but we will be trading it because it has been really volatile and making good moves, but all to the upside. Every time it's dipped, it's been a buying opportunity as of lately. So that's what we're going to be looking for in this trade, and hopefully we'll be able to take some profits on it this week. Thanks a lot for watching the video, and we'll see you this week. Good luck.